All right, I think we're live.
We're live?
Yeah, we're live. All right.
Yay.
Okay.
We figured it out.
Do you want to do introductions first? I mean, everyone's who
I'm
you are.
Jason.
Yeah. This is Jason, the Wizard of Ops. I'm Jill. I'm Jason's wife. I'm behind the scenes. Those in Discord, you've seen me quite a bit. For everyone on YouTube, I am strictly behind the scenes until today. So nice to see everyone. All right, so let's get into questions. I'm going to be feeding questions.
Oh, you feed me questions? Okay.
Yeah, and then because we had let's see, 13 questions submitted in advance. So everyone who's submitting questions now, we'll try and get to everyone if we can. If not, we'll address it at another time. Good to see everybody. All right, so let's get started.
I don't see anybody.
You see, look, 15 people. There's everybody. Okay. All right. So one question we had yesterday was what makes the first two 0DTE updates citial and not JEX?
All right, hold on. I got to share my screen for this one.
Is that possible?
I don't know.
It's our first
share
time.
a link.
It's our first time doing a.
Let's share a live stream. How do I share my screen?
I don't think you can do it on this. I think we need to try something else. Do you want to just like talk through the paradigms first? I mean, I can do the display with my fingers. You know, let's do that.
Do the display with your fingers?
Somebody asked for finger puppets. You're going to get something that's pretty close. All right. So this is Bank of America paradigm. Stop. It is. This is citial paradigm. This is JEX, and this is anti-JEX. All right. For more information and much more sophisticated graphics, you can. We'll go to our Discord for that.
Yeah.
We'll post something with nicer graphics later. All right. So.
I'd really like this. I don't have access to the feature of sharing my screen.
You should. Either way. Well.
All right. Well, whatever. Okay. So. All right. Yeah, I guess you're gonna have to go on Discord. I had all these things, all these questions all lined up. So. All right. So we're talking about yesterday and my first two updates at 10:28 a.m. and 11:23 a.m. And what's the question again?
The question is what makes the first two updates citial and not JEX? So citial is this way.
Yeah. Well, first of all, I never said it was citial.
It's okay.
But all right. So let's go back to ultimately what these paradigms are based on and how to trade them are based on. You know what? I'm going to turn this on.
Sure.
We need to turn on the light when I saw that thing. So now it feels like I'm interrogated. All right. Dealers want to be completely hedged. They want to have no risk whatsoever in their portfolio, right? That is what their goal is. The easiest way for them to do that, especially midday, and not be completely price insensitive, is to make sure that aggregate Vanna and aggregate Charm, coincidentally, are neutral. Okay, they want it to be zero overall. Now we know, of course, that on an individual chart, I know I'm answering another question now, but on an individual chart, on an individual strike, the Vanna and Charm are zero when the price is directly on that strike. On a, I guess you could say, on a short put that's out of the money, it is negative. On a long call out of the money is also negative. Okay. And that's why we were that's like that JEX paradigm. The opposite is true as well. And if you're short a call and that's in the money, that is positive. Okay. Now, I'm sorry. I'm talking Charm. Okay. I'm talking Charm. Should have probably said that in the beginning. Now that we have that in place, okay, when I look at these charts, when I look at these 0DTE Charm charts, what I'm thinking is, what does the price have to do in order for Charm to become zero, which is exactly what the dealers want, okay? And the dealers will make it happen. They can make it happen. Some days they can't, and some days, you know, there's macro bros or whoever that's adjusting price, but many times, like especially Friday, the dealers can do it. So we're going to look at Friday's two updates, where the price was, I think it was like hovering at around 42 or what is it, like 42.70 or something like that. I can't even share my screen, so I can look on the chart though. And I'm looking now at SPX chart and Thinkorswim. And so at 10:30, SPX was at, it was at around 42.50, right? So the price here is around 42.50 in this chart that hopefully you're looking on Discord and seeing. It's at my 10:28 a.m. update. And if we zoom in a little bit, you'll see that around it, like it's between these green and the red bars that are to the left. Okay. If price were to go down, the charm would be less balanced. It'd be more and more negative. Dealers don't want that. Okay. So, and Vanna, it's, you flip the signs a little bit because charm is negative, Vanna is positive, but dealers don't want that. It would make Vanna less balanced to the positive side. It would make charm less balanced to the positive side. So if the price started going down, dealers would probably look at that, look at the Vanna, and look at how imbalanced they are in 0 DTE, charm, and Vanna, and they would try to push that price up either through option trades, underlying, however they want, however they can do it, they're going to do it. So that's why I said look at 42.40, which is the highest green bar right there. Look at 42.40. That's probably going to be a floor, because once the dealers start seeing price getting more and more negative, that's exactly what they don't want, and they would try to push price up. And that's what happened twice on yesterday, right? So what would dealers have to do in order to make this balanced? Not just that price doesn't go down. I mean, if price stayed exactly the same, they are still imbalanced. It's still too negative. In order to make it balanced, they want to try to get it up to 42.65, 42.70 area, right? Maybe 42.80. Okay. So I was saying target 42.80 or so for now, because, I'm expecting, this is 10:30. It's a little bit early, but I'm expecting a little bit more option purchases and sales. That is why I selected these that's why I selected these targets, is because the only question I'm asking on 0 DTE is what does price have to do for dealers to remain balanced? Did I answer the question, or did I not answer the question?
I think you're good. Either way, that person is not watching live, so they'll tell you if you know more information. They said, I'll watch the recording. It's okay. All right. Do you want the second question?
Oh, no. Is it to determine if a charm level has flipped?
That's question number 2.
Okay. To determine if a charm level has flipped, Vanna equals 0 on the strike. Charm equals 0 on the strike too. Noted. It is determined via aggregate chart or individual strike on Vanna. Okay. So Vanna and charm are two sides of the same coin, right? All right. And whatever we say regarding this topic about Vanna, we're saying the same thing about charm. Okay. So let's just kind of, the only difference is charm would be negative and that's bullish, and Vanna would be positive and that's bullish. Okay. So you're saying, how am I determining where balance is? Like how am I determining what this is? Right now, I'm eyeballing it. Okay. Obviously I have the live version. So every 5 minutes, I'm looking at this chart and seeing the dynamic changes every 5 minutes of, this has gotten more positive. This has gotten more negative. And you could also look at the aggregate. You could look at the cumulative to see, okay, it needs to gain another 10 million or another 20 million. So you look on this chart to see that the bar chart to see how will 10 million be flipped to positive? Like at what price would 10 million be flipped to positive at this moment? And so that's kind of, it's essentially, I guess, the step-by-step thing I do is I guess I look at the cumulative chart and I say, okay, we're imbalanced by X million, X billion, whatever. And then I look at the bar chart and say, okay, what does price have to do in order to make this zero? And that's when I say I have a bearish lean, I have a bullish lean, I have this. Okay. Does that make sense? All right.
Next question. How to determine the spot vol correlation variance? What time of the day does it come into play? How to plot it on the chart?
Okay. So the spot vol correlation is a daily tenor measurement. I have not yet measured it in any like less term, but basically it is close to close SPX change on a scatter plot against the number of points that VIX changed. Okay. Again, I cannot share my screen, so I can't show you. The way I got that plot that's in the user guide is I have it's just 2022 on that plot, but I mean, you can do this with any term. From January to December, every day's SPX percentage change versus every day's VIX point change, not percentage change, point change. And you just plot those two on a scatter plot. It will give you, a bunch of dots, and you can easily get regression statistics on that. And what was there a follow-up part to that question?
So it's how to determine it. What time of the day does it come into play?
It always comes into play. So, I mean, it's always something to keep an eye on. It doesn't necessarily mean that it will end the day on the correlation, or even like close to it. Sometimes it does not end the day. Earlier, like way back, I guess years ago, I guess now, I talked about the over-vixing and under-vixing dynamic. So especially in the bull market, many times when there was a big drop or a liquidity event like February 2018, for example, which was Volland Academy, big liquidity event, VIX expanded, and it ended the day way over-vixed. Every single time that happened, within the next 2 weeks, price returned to where it started on that day. And that was 100% happened every single time. Ironically, and it had to happen with over-vixing of at least 2 points, okay? Ironically, through this whole bear market, through the whole, recession scare, the banking crisis, everything, we've never had one day where we were over-vixed by 2 points. The closest was the banking crisis, which was like just shy of 2 points. So it is pertinent all the time. The official like trade plan that was based on it is for the end of the day. The next day, you basically go bullish, at least for 2 weeks out. Usually I went 1 month out to give it a little bit of time, but it always kind of comes into play, particularly when there's very positive VANA. The more positive VANA there is, and all expirations, the more it will come into play. That's always kind of the way it's been. But, on Wednesday, when, we kind of struggled a little bit, I was segregating my zero DTE analysis from my VANA analysis, and you can't do that. You got to use it both. And zero DTE will always get overshadowed by the big, huge all expiration stuff from VANA. So did that answer the question?
Yeah. And you discussed how to plot it on the chart.
Right? Yep.
Okay, cool. All right. Next question. For a day trader on futures, what would be the best Greek or Greeks to use for entry and exit? Charm, gamma, DAG levels, etc. This would be from the 10 a.m. to 2 p.m. time frame before dealer o'clock. And now, do you want to define dealer o'clock for everyone?
Sure. Dealer o'clock is 2 p.m., give or take. Now, I mean, I know that, I'm kind of declaring 2 p.m. as dealer o'clock. Obviously, dealers do, they could see all the order flow. So they know right away, like when is the best time to hedge. And so they're not going to do it at 2 o'clock every day. They'll get front run by every single institution in the world. So dealers aren't idiots. But Ken Griffin doesn't make money by being an idiot. So Dealer o'clock is around 2 p.m. We notice like that's around the average time it is. What was the question? Oh, so what's the question? Oh, day trader on futures. Okay. I know that when you are plotting, pretty much all of you day traders, I know because I'm getting questions throughout the day, is that you guys like to do your homework, and you have to do your homework, and that's great. However, the way the day progresses, you're going to have to do your homework, but plan for alternative option positioning. Sometimes there'll be dealers buying a lot. Sometimes they'll be selling a lot. You don't know until the day begins how zero DTE is going to hash out. If you try to look at zero DTE prior to the day starting, it gets completely overrun by that same day trading really quickly. If you look at the open interest right now on Monday's options, you'll probably notice it's maybe 10K at most, 20K as far as like the largest strikes on SPX. Monday at the end of the day, you look at the volume and it's 200K on those same strikes. So they get overwhelmed pretty quickly. So it's going to be hard to be flexible when you're watching this. Furthermore, we were talking about how dealers are, roughly 35 to 40% of all market moves. They're responsible for that. But that leaves 60% of other people trading. So you kind of have to keep in mind, like, okay, what do dealers need to do and what may other people do? Last Friday was the non-farm payroll report. Whatever came out of it, you knew what the dealers were going to do, give or take. You knew that there's some event vol in there. You know that Vanna is very positive. So as that vol falls off, you knew that there was going to be a push to the upside, at least a little bit. But what if the jobs number came in at negative 2 million? Market would sell off. No matter what dealers would want to do, the market would sell off if it came in like that. So I know that there's a lot of day traders, you like that structure. What I'm saying is you might need to be a little bit more flexible as the day goes on. Now, if you're a futures trader, and now I'm going to answer the question finally, what should you be looking at? That whole zero DTE charm thing that I explained before, where is it balanced? That is the target. That is the dealer's target. Okay. Again, there's other people that may push it, and on Friday it pushed it $2. Again, sorry, Courtney, out of the way. But balance is what the dealers want. And the dealers are a majority of the market moves. Like, not a majority, but they are the largest portion of market moves. So that's the first thing to think about. When you're talking about stops, right? You could look at that 10:30 a.m. update. You look at, dealers do not want it to get less balance. So you start looking at stops as the place where the dealers would be most imbalanced. Okay. It also is not as clearly defined as, most of you day traders came from a technical analysis background. It's not as clearly defined as here's a trend line. If it crosses, then you're breaking out, or here's a trend line. If it bounces back, if it's rejected, sell, or something like that. It's not as clearly defined like that. And really markets aren't. So, you're welcome. But when you see implied volatility being over or under VIXed a lot, then I better pay attention to the bigger Vanna picture to help me with my thesis. A couple times, not last week, but the week before, I saw calls being bought very heavily and thinking there's nothing here. Implied volatility is not messed up. There's nothing here. This is very bearish. I'm going to go bearish. And next thing you know, Joe Biden comes out and says, we're going to have a deal. We're not going to default. We're very close to a deal, or something very positive with the debt ceiling deal. And those calls were realized all of a sudden. Those calls flipped to negative, and it became like a very strong push, right? So, you kind of have to keep in mind what may happen. And, no trend line is going to stop them. Okay. No, but dealers may try. Like when Biden came out at 2:30 and said that they tried to get over the calls, and the dealers were like, no, we like balance. We're going to go to balance. So I guess my answer is you have to see what the market is presenting to you. You could look at your 0 DTE charm, if not, because that's even though it's probably the least impactful, it is the most likely to be used, because most of the time nothing's going on. Most of the time these macro bros, they're sitting there with their long bonds or short bonds, or and they're just sitting there waiting for the market to do what it does. But you have to look, is implied volatility high or low? And if it's way too high or way too low, if it's way too low, like it was on Wednesday and Thursday, I better check out that Vanna and what that Vanna looks like, because, on all expirations, because with this much implied volatility going down, I'm going to have, Vanna on the grand scheme of things is going to have a larger impact. If you know that there's going to be some kind of data FOMC release or something like that, you're going to have to keep in mind the reactions to that and how the dealers would hedge in reaction to that. So unfortunately, it's not going to be as clearly defined. You kind of have to keep a watch list of many of the things in the market and keep your ear to the ground for news events or something that would cause non-dealers to buy or sell. Okay, what's the next question?
Next question is, would it be beneficial to have, say, 7 expirations of Vanna levels plotted on our chart for intraday targets?
So you're saying expirations from 1 to 7? So no.
All right, next question.
No. I'm trying to figure out the best thing to do is to have charm, your Volland window open to charm. And it doesn't even need to be charm 1 expiration, because the 1 expiration that's 0 DTE charm is going to overtake the rest of the charm anyway. So as long as nothing else is happening with the market, there's no implied volatility crunch or raise or something like that, just keep open your charm window. It'll refresh, and every time it refreshes, you just say, what do the dealers need to do to balance, and just adjust your target to that.
Cool. Next question.
Mm-hmm.
All right. Bottom line question is, when to enter and exit long or short on shorter intraday time frame?
Did I answer that already? So I would enter. I mean, yeah, sure. The more imbalanced the charm is, the further away it is from 0. Oh, excuse me. I'm talking too much. I'm giving myself heartburn.
Jason is a tea drinker, by the way, and so am I. We don't drink coffee. That's
true. And I just put honey in my tea, and I'm a honey snob.
He is.
Don't give me honey that's shaped like a bear. Clover honey. It's basically sugar. Anyway, why would you get honey made from weeds? Anyway. So the more imbalanced charm is, again, assuming that, the rest of the market is calm and nothing's going on, the more imbalanced charm is, the more you'd want to buy or sell. Like if it's very, very, very positive, you want to sell. And I'm very, very negative, you want to buy. So the target is near balance. And I only say near balance so that you can kind of give yourself a little bit of room. You'll probably miss the last 5 points, last 10 points, something like that. That's okay, because you made money. Nobody complain. Don't complain when you make money. I know there's a lot of people, I'll just go off on a tangent. I like it when people are like, when I sell my winning position and then the market continues another 10 points, I'm like, oh, you could have sold 10 points away. I'm like, look, I made money. I'm not complaining. I'm moving on. Like, move on to the next. I think that we can reach 43.20, but I sold my bullish wing. Why? because I made money. My return to risk is low for keeping it, and I'm, sell it, make money. All right.
Next question. All right, we
Don't
got
be
a couple.
greedy.
Yeah, don't complain about profits. We have a couple questions about implied volatility.
Okay.
The use cases of implied volatility. At what point the aggregate overall is more important than the local 0 DTE volume for Vanna and Charm?
The use cases of implied volatility.
Yeah, I guess applying it to your trading and your charts and such.
Okay. So, all right. Implied volatility is a measure of supply and demand for options. Okay. Options are originally and still predominantly used as a hedging product, as an insurance product. All right. It could kind of draw the parallel between options and like home insurance. Okay. Flood insurance, because that's usually not included in your home insurance. So let's say flood insurance. Now, let's say I'm living here in Virginia and a hurricane is on the way. So a debt ceiling negotiation is happening, or a bank crisis is happening. Right? The bank crisis is probably a better example. A bank crisis is happening right now. Everybody who doesn't have flood insurance is rushing out to their State Farm agent, not affiliated, and running out to them, knocking on the door and saying, I need flood insurance right now. Do you think they are going to charge more or less than if a hurricane is not coming? They will charge more because the hurricane is about to show up. They'll probably have to pay out because hurricanes cause floods. So when something is happening, a banking crisis or something is happening, what are dealers going to do? They're going to charge more. They want to make sure that they have the liquidity to service everybody. They know that the demand is going to be rushing through the door because not enough people are hedged, and they are going to price for it. They are basically the price gouging. They are the gas station charging you $10 instead of $2 when there's, some kind of gas shortage or something, even though they have plenty. That is what dealers are doing. Okay. So that's the use case for implied volatility. And if you think about it like that, like a supply demand balance. Okay. And, I know I probably, shouldn't mention this, but Shem Karsan talks about contracts being oversupplied or something like that. What that means is that the premium is too low for how much volatility there has been. At least that's what it's supposed to mean. I don't know what he really means, but that's what it's supposed to mean. And sometimes when he says that, you guys, ask me about it in the thing, I'm like, what is he talking about? And realized volatility is 12 and implied volatility is 15. What is he talking about? Right. But that is kind of what your measure of oversupply and undersupply. Now, there is also this thing called variance risk premium, which is for the price of gamma. If you're going to buy a long call, you have infinite gains and limited losses. That the price of unlimited gains for limited losses is called the variance risk premium. You're going to have to pay a little bit more than realized volatility or the, expectation of movement. So there is about a 1 to 2 point buffer between realized volatility and implied volatility, which is also why I sold my bullish vertical on Friday, because now with implied volatility reaching, VIX reaching 14.5 and realized volatility being 12.5, just look up the ticker RVOL, RVOL. Probably have to use Yahoo. I don't think it's on Thinkorswim. It's a CBOE product. But anyway, the comparison of those two should be with, around 2 points. Okay. And that is normal volatility, right? So when you see that, that's when okay, I'm expecting implied volatility to come down or go up. And if there is like a difference of 2 points, say it's like 4 points, maybe it's because there's an inflation print coming up or an FOMC decision or something like that. So you have to keep that in mind, or, Russia's lining tanks up against the border of Ukraine or something like that. So And a lot of times that's when implied volatility expands. So you kind of have to keep that in mind when you're thinking about implied volatility and trying to predict what implied volatility is going to do. Back when I had, for the 2 months or so, or I guess it was like a month and a half that I had that iron condor, implied volatility was up in like the 20, 21 range, and realized volatility was down in like the 13, 14 range. That's way too wide, and there was nothing on the radar to cause that. So I think that answers your question. Like, how do you use implied volatility in your trading? You want to be able to try to predict implied volatility going up or down. And that was kind of the framework that I use. Start with realized volatility and then see what is upcoming and see if it warrants an implied volatility spike or something.
Okay. People are very concerned about you scratching your nose. They want to know if you need a tissue or if it's just a nervous tick.
I'm scratching my nose.
I can get yes.
It's itchy right here. I don't know why.
Yeah, so he's fine. He doesn't need a tissue. He's all right.
But I have heartburn now, and that's not cool. But
anyway, next question. Okay. Regarding spot vol correlation, I assume that it is not a written in stone thing. I imagine it deviates a lot, but maybe in expectable moves. At what point should we start putting attention to? 10 to 15 points difference? Like, what's the area?
So spot vol correlation, I'll be honest with you, barely changes. It is usually like that linear regression that I showed you. Pretty much it doesn't vary very much for the history of options. Well, at least until the 87 crash. What?
Nothing.
She's getting up. I have no idea where she's going. Okay.
That's on my birthday. 87 crash.
Yeah, there you go. 87 crash on Jill's birthday. So that's what everybody remembers.
Yeah, that's what I remember.
They had to cut her candles in half because they couldn't afford it anymore.
That's true.
What was I about to say? Oh, so when to start really paying attention to it? It'll vary a little bit. When you say 10 and 15 points, I hope you mean 0.10 and 0.15 points, because if VIX is 10 points too high, that's oh, sorry. Be concerned about my heartburn, people.
Oh man.
But if it's 15 points too high, then market's probably breaking. It's probably a really, really bad day. But like 2 points at the end of the day is like my official measurement. Really like 1 to 1.5 points is when I start noticing. So
cool. All right, Vanna and Charm. This is a Vanna and Charm question. Vanna and Charm flip. But why does it happen? And is it immediate? Or do we have to wait and see if the market can hold above or below a strike?
Why does it? Okay. The math answer was given by somebody on Discord before. Who gave that the math answer? Because that's Dumbo. Dumbo gave the math answer.
Is this in the this is in one of the.
This is in day trading room,
yeah.
And he's basically looking at the chart of Vega and looking at what's the derivative of that chart. Well, Vega is peaked at the money, which the derivative of that is 0, right? So that's the math answer. I'll give you the practical answer. All right. An option that closes out of the money, it expires out of the money, has a delta of 0, no matter what, right? An option that closes in the money has a call that closes in the money has a delta of 100, no matter what. And a put that closes in the money has a delta of negative 100, no matter what. Okay. That is like, that's just facts, right? So let's take the case of a call, right? Stay with positive numbers, right? You're an out of the money call. Let's say, a 30 delta call, 0.3 delta. And spot price doesn't move, but implied volatility comes down. Okay. Now, when we talk about flipping sign, when you have a positive Vanna, that means that the delta and the implied volatility are going in the same direction. So when one goes positive, the other one goes positive, right? Hold on. I have to sneeze.
I'll get you a tissue.
Yeah, sure. Anyway. And when it's negative, it means they're going in the opposite directions. So let's take a thought of an out of the money call long. There you go. Now I'm going to have tissue residue on my mustache.
Be fine.
Okay. All right. So we have a 0.3 delta call, and price doesn't move. Implied volatility comes down, right? That 0.3 delta call, the delta also comes down on that long call. So that means that it has positive VANA because they're both going in the same direction. All right. Now let's say it's an in the money call, which would be a 0.7. It's like the, equal delta away from the price. Now it is not coming down when implied volatility goes down because you have less likely of a chance to reach that call. So, or for the call to fall out of the money. So it goes from 0.7 to 0.8 or to 0.9. So instead of the delta decreasing when implied volatility comes down, the delta increases when implied volatility goes down. And that's the practical way to kind of think about VANA in why it flips, like, conceptually in your head. And dealers hedge to the deltas. They do not hedge to the P&Ls. So when the delta is changing on those calls, they are going to have a different buying or selling behavior. Now, again, 0.5 is where VANA equals 0. So the closer you are to 0.5, the less the VANA changes when implied volatility goes up or down. And the sphere of influence, I guess you could say, where VANA is strongest is at around like the 0.35 to 0.2, 0.15 area. It depends really on time, on days to expiration. But that kind of area is where you'll always see like the kind of spikes in VANA for an individual strike. So, all right, what do we got?
Okay, next question I'll give
But
you.
did I answer the question?
Yeah, yes, you're good.
All right.
Next is a quick one, hopefully. It's what's the difference between the line in the sand and the target, and how would that look on the Charm 0 DTE chart?
So we kind of discussed this before. For me, for really dealers, the line in the sand is where the charm starts to go from bullish to bearish or vice versa, right? And essentially when dealers reach the line in the sand, things, the charm flips to the point where it gets more and more and more bearish. So where the balance point, even though it could go up to be a balance point, they have to sell in order to hedge, and they have to keep selling in order for, have to keep selling to get all that charm out of the money, to get it far away from the current price. So really, the line in the sand is when the dealers have to cause continuation in order to get charm, in order to hedge, and the target is when dealers have to stop or cause resistance in order to reach balance. So, does that make sense?
Mm-hmm.
Okay, good.
Next question. And if you guys are on live chat and you're like, hey, that didn't make sense, you can always let us know.
Yeah, say something.
Yeah, please say something. All right. Given the Volland DAG calculation, and DAG is delta adjusted gamma.
Yeah.
Is there any value in gamma analysis? What would be a use case of using gamma, either instead of or in conjunction with DAG?
DAG was a response to our early subscribers who wanted something that looked like JEX. And they wanted to be, when people were looking for like the JEX break-even points, DAG was the best illustration to help people understand that. I honestly would rather use gamma. And the reason why is because the way DAG is calculated, it's not like very secret. Any strike above price has their gamma flipped. That's it. That's the only difference. And personally, I like to see where gamma is negative versus positive. So if you cross over a strike, it's not flipping a sign. I know DAG is flipping signs, but gamma really isn't. So I like to look at gamma myself, and it may be just because it's kind of how I was trained and looked at. But for DAG, I did it in response to people asking for better visualization. So the difference between reading the two charts is when you're reading DAG, green is bullish, red is bearish. Just that's it. When you're reading gamma, green is support or resistance, and red is permissive. And I don't know another word for permissive. People sitting there saying permissive. What the hell does that mean? It means it'll go through easier.
More of an open door.
That's what she said. Okay.
Hey, I did say that. All right. So next two questions are kind of the same, so I'm going to combine them.
Okay.
Best way to utilize Volland to identify intraday support and resistance levels. And then this one is kind of long-winded, but so I'll just read it out. I get it, market makers hedge on the early morning and the last hour or so of the session, but then what's the point of Volland Live? So I guess intraday for Volland Live. This is a serious doubt. Is it okay to assume that the intermediary moment from the first hour and the last hour, we can simply use gamma to scalp day trade and maybe even do that by following direction determined by the early readings of 0 DTE?
Second question was risky, wasn't it?
Yeah, you can tell. Again, long-winded. It's all right.
All right. So, okay. I'm beginning to regret that I put that in the user manual, but I'm trying to be comprehensive. But first of all, 0 DTE large gamma strikes are going to be the large charm strikes when you get there. Okay. The thing to look for intraday, it said entry and exit or support or resistance, or
it said support resistance. Yes.
Okay. Again, support resistance is where the dealers would be the most imbalanced. The target would be where they are the most balanced. Maybe I should put that in the user guide. How come sometimes I say things and I'm just like, I should write that down and we should put that in the user guide. There you go. Target. Support or resistance is least balanced. Target is most balanced. And by balanced, we mean closest to zero aggregate. Got it. Did that answer both questions?
Yeah, I believe so. And if you guys...
Should I be more long-winded in my answers?
No, please don't. All right, so you have answered all the questions that came in advance. So I'm going to see if there's any more. Let's see. So folks are asking about the charts you are referencing. I'm posting them in the public general Discord. There are some that are in the subs only, especially the day trading one you just mentioned earlier. Let's see. Linear regression. I guess Risky is wondering about linear regression. I don't know what about linear. It's okay. We'll talk about that later.
Take econometrics.
There you go. Read it.
It's like 2 or 3 years of econometrics that you're talking to here. Actually, semesters, not years. Who could take that many years?
I don't know. Let's see. How do you see implied volatility? We already talked about that. I think
there will come a time in which we're going to have a vol plane visualization in Volland. It is an important aspect. And like fixed price vol and stuff like that are not very prevalent in the market. People try to sum it up into like one VIX number or one, but we actually do have the implied volatilities, the fixed price volatilities, and we will display it before the end of the year, probably before like the fourth quarter. So
it's exciting. All right. Last question that I have on here, people saying you're doing great. Hey, thanks. Why do you throw your edge just for free? You're doing great for the community, but those info you are giving are worth $. Money. I mean, honestly, like this is to help people learn Volland.
Well,
Volland's not free, you know.
Yeah, Volland's not free. Here's the thing. Taking a step back from Volland, the financial complex, the investment complex is it is, and this is a better question for Pablo than it is for me, but it is a very exclusive club. I mean, you watch Trading Places, right? That's a great movie, by the way. If you haven't seen Trading Places, watch it. It's good. Dan Aykroyd. But anyway, all those, harumph Dan Aykroyd types in the beginning of the movie, all sitting around this huge table, and they're it's a boys club. And I'm not saying there's no girls or whatever, but it's a boys club. It's an exclusive club, and I'm not invited. So while this edge exists, and I am not in the boys club, I am in the ape club. So I'm here with you apes, and I figured something out, and I'm sharing it with the club that I'm in, the ape club. I'm not in the Wall Street club. They have the billions. I do not. So unless some of you are willing to give me $2 billion, I will continue to share it with the ape club and get paid in that way instead of getting paid in the the traditional way. That being said, now that I've gone over to the boys club in the option industry conference, I'm learning that even though they are very exclusive, there doesn't mean that they're very creative. They have people, my brother-in-law worked 20 hours a day, in Bank of America trying to be in the boys club, and he got out. I mean, but they're working 20 hours a day, and what are they doing? They didn't do Volland, that's for sure. So I'm learning that just because I'm not in Wall Street doesn't mean that I'm not good at what I'm doing. We could figure things out without their help. They may have the upper hand, but if they don't have the creativity, then they don't have crap. So why am I giving away edge? Number one, it's, I'm helping the club that I'm in. And number two, there'll probably come a day in which some, the boys club will start making offers anyway. So at some point in time, I'll get paid, but I don't care. That's not my goal here. My goal here is to really, it's to help you as traders, not just with trading, not just with edge, but with, everybody in this Discord and our subs. The great thing about it, even though I know you're all frustrated by it, is that we are all stepping together, learning together about this new thing. And it is taking patience. We're all learning, including me. There will be Wednesdays out there. We're learning what to see, and there's a lot of people that have different perspectives on macro events. There's a lot of, and we're collaborating, learning together and advancing. And in that way, we are learning to be more patient. We're learning to be more disciplined. We're learning to be more analytical. And really, the money is just, as long as we keep the process and the learning going, the money will come. And that's really where we're at. So.
Okay.
Is that it?
Yeah, we're done. Done with all the questions.
Okay, good. I can go take a Pepto-Bismol.
All right. Yeah, we'll go ahead and let's go back. And where are you going? You're on your screen over here?
I'm over there, yeah, because I had to sign in as...
All right, cool. All right, well, thank you, everyone.
A lot of people said stuff.
Yeah, I was telling you, lots of people were commenting. And...
Linear regression. You put linear regression as a question mark.
Yeah, she didn't know what it was.
Oh, you're going to have to look it up. There's that is not a, there's semesters in there of econometrics.
So yeah, thank you everyone for watching. Hopefully next time we figure out how to share the screen so you can see these charts and we can do it more comprehensive for those of you like me who are visual learners. But either way, we appreciate you all being here. Thanks for joining us on your Saturday, and have a good rest of your day.
I was asking if it as linear algorithmic. It's not the same thing. You look it up, Wikipedia, linear regression.
All right, bye everyone. We'll see you in Discord.
Bye. I don't see anybody.